Welcome back to the Deep Dive. Today we're diving into a book called Smart Investors Keep It Simple, Creating Passive Income with Dividend Stocks.
Sounds interesting.
It really is. It's
Yeah.
all about, building wealth steadily
Hmm.
and not, stressing about every little market blip.
Right.
Ever dream of having income just flowing in even when you're not working?
Oh, yeah.
That's the allure of passive income, and dividend stocks might just be the ticket to get you there.
They really can be. This book jumps right in and shows how, like, the big players, the Bill Gateses and Warren Buffetts of the world do it. They use these things called holding companies as part of their strategy.
Okay, wait. Holding companies. That sounds maybe a little intense. Is that something like we regular investors need to worry about?
It's really not as complicated as it might sound.
Yeah.
A holding company is basically just a company that owns other assets. So it owns stocks and bonds and maybe real estate and all sorts of things.
Oh, okay.
You can almost imagine it as like a parent company that has just a diversified investment portfolio.
So like a parent with, a savings account and also some rental properties.
Exactly.
Not necessarily like building this huge business empire, but spreading the wealth around a little bit.
Yeah, and that's what's so fascinating about it. It's like a blueprint that we
Yeah.
can kind of apply those same principles even on a smaller scale. You don't need billions to start.
Right.
In fact, the book actually encourages starting small.
Right.
Even a single share of like a really solid company like Coca-Cola can be a great first step.
Oh, that's a relief. That makes it feel a lot more approachable.
Definitely.
But before we get too far ahead, I think let's back up a bit.
Okay.
For someone who's brand new to all this,
Yeah.
can you explain what a stock actually is?
Yeah.
Like, what does it mean to own a piece of a company?
Sure. So think of a company as like a giant pizza. Each stock represents a slice of that pizza.
I like where this is going.
Right. When you buy a stock, you are essentially buying a portion of ownership in that company. Now, of course, with like most public companies, there are millions of slices. So your individual ownership might be tiny,
Right.
but it is ownership nonetheless.
Okay, so the pizza analogy, I think I get that. But where do dividends fit into all of this?
Dividends are like the extra pepperoni on your slice.
Oh, okay, I'm with you.
They are payments that companies make to their shareholders, essentially sharing a portion of their profits. It's like getting a little bonus just for being a part owner.
Now, I've always thought of stocks as a way to make money by buying low and selling high, riding those market waves.
Here,
Why should someone care about these little pepperoni dividends instead?
that is a fantastic question, and the answer lies in the difference between capital gains, so that buy low, sell high strategy, and then passive income.
Okay,
Capital gains, they can be exciting, don't get me wrong,
right.
but they're also kind of unpredictable and often risky. Dividends offer a different approach. It's a steadier stream of income that is less dependent on market timing.
So it's less about trying to time the market perfectly and more about owning a piece of something that's just consistently generating income for you.
Exactly. And here's where it gets really interesting. Historically, dividends have actually been more reliable than capital gains, even during tough economic times.
Wait, really? Even during like a market crash?
Even during a market crash, think about it, like even during the Great Depression and the dot-com bubble burst in 2008, like lots of companies continued to pay and even increase their dividends.
Wow. That's pretty incredible. Okay. You've definitely piqued my curiosity here, but I have to ask, if dividends are this amazing, why aren't they more popular?
I think it goes back to that get-rich-quick mentality. People are drawn to the excitement of potential rapid growth.
Oh, yeah.
It's like the classic tortoise and the hare scenario. People often chase the hare of capital gains,
Oh, yeah, I see that.
overlooking the tortoise of slow and steady dividend income.
Yeah, so they're so focused on the quick win, they miss that kind of long-term strategy.
Yeah, they're overlooking the dependable friend for the allure of the flashy newcomer.
Yeah.
But as we've seen, it's that dependable friend, those consistent dividends that can really help build wealth over time.
Okay, I'm convinced dividends are definitely worth a closer look. But how do I actually get started? Where do I go to buy these dividend-paying stocks?
Well, the first step is you need to choose a brokerage account. So that's basically your gateway to the stock market.
Okay.
This book actually recommends TradeKing,
Okay.
and that's known for its low fees and user-friendly platform.
Trade King got it. Now, what about actually, like, buying a stock? I imagine it's not as simple as walking into a store and saying, give me one Coca-Cola stock, please.
You are right. There are a few more steps involved, but it's still pretty straightforward. Once you have your account, you can buy or sell stocks electronically. You'll need what's called the company's ticker symbol,
Okay.
which is kind of like a stock's shorthand code.
Okay.
And then you'll choose an order type.
Okay. Ticker symbol that rings a bell? And order type, what does that mean?
So there are a few different types, but the most common are called market orders and limit orders. A market order is like saying, get me in now, at whatever the current price is.
Got it.
It's fast, but the price can fluctuate from second to second.
Right.
A limit order lets you set a specific price you're willing to pay.
So if I'm trying to snag a bargain, a limit order is the way to go.
You got it. It gives you more control.
Got it. So let's say I've got my TradeKing account set up. I understand ticker symbols. I know about order types. How do I actually choose which companies to invest in?
That's where the real detective work begins.
Okay.
And that's exactly what we'll dive into right after this.
Okay, so we're back and ready to put on our detective hats.
All right.
How do we go about choosing the right companies for our new dividend portfolio? I
Yeah,
imagine there's more to it than just, picking companies whose products I like.
absolutely.
Right.
You're absolutely right. While personal preference, can play a small role, it's really crucial to kind of dig deeper and analyze a company's financials, their competitive edge, and their overall growth potential. It's like due diligence, before making a commitment.
So it's like investigating a potential business partner.
Yeah.
We want to make sure they're the real deal and not just putting on a good show.
That's a great analogy. We're essentially becoming financial detectives looking for clues to determine whether a company is a worthy investment. And luckily, this book breaks down these kind of key metrics that, even a novice investor can grasp.
Okay, I'm ready. I'm ready to channel my inner Sherlock Holmes. What's the first clue we should be on the lookout for?
Well, I always say start with the company's revenue and net income. So revenue is the total money coming in from sales.
Okay.
And then net income is what's left after all the expenses are paid. Salaries, rent, the whole shebang. Think of it like your own personal income versus your take-home pay after you pay all your bills.
Got it.
Yeah.
So just like we want to see our own income growing over time, we should be looking for companies that are steadily increasing both their revenue and their net income.
Yes, exactly. Consistent growth in those areas is a strong indicator of a healthy and profitable business. And the book actually highlights a couple of really great examples. So Fastenal, they sell industrial and construction supplies.
Okay.
And then also Estee Lauder, the cosmetics giant, both show really impressive steady growth in both revenue and debt income.
Those sound like some success stories worth emulating. What about companies that, might be flashing some warning signs? Like, what should we be looking out for on the other end of the spectrum?
Yeah, well, the book also examines a couple of kind of cautionary tales.
Okay.
So Sprint, the telecommunications company, and GameStop. Sprint's revenue has been steadily declining,
Oh,
while their net income is all over the place, even dipping into the negative sometimes.
yikes.
Yeah, and then GameStop has seen this downward trend in revenue and very inconsistent net income, including several years of losses.
Definitely some red flags there.
Yeah.
For sure. It makes the point that, we need to carefully scrutinize a company's financial track record. It's like checking someone's credit score, before lending them money.
Precisely. We want to be confident that the companies we're investing in are financially sound and capable of kind of weathering those inevitable economic storms.
Right. Now, I've often heard the term competitive advantage when discussing investments.
Right.
What exactly does that mean, in this context?
So Warren Buffett, the, legendary investor, calls it a moat.
A moat.
Yeah, a moat, like
Okay.
a protective barrier shielding a company from its competitors. Think of it as like a superpower that gives a company a distinct edge in the marketplace.
Okay, so it's more than just having a catchy jingle or a recognizable logo.
Right.
What are some examples of these moats?
So there are several different types. One is like having a truly dominant brand. So think about like Pampers diapers. Even if a competitor came along and offered like a similar product at a lower price, lots of parents would still choose Pampers because of their, trusted reputation and that established brand loyalty.
Oh, yeah, that makes sense.
Right.
So it's like a built-in advantage that makes it really hard for competitors to steal their market share?
Absolutely. Another powerful moat is what we call a high barrier to entry. So take pharmaceutical companies. Developing a new drug requires extensive research and clinical trials and regulatory approvals. It's not easy for new players to break into that market.
Right, so we're looking for companies that have something special, something that sets them apart and makes them, more resilient in the face of competition.
Absolutely. And, a good way to kind of gauge a company's moat is to ask yourself, if they raise their prices, would customers still buy their products? If the answer is yes, that's a pretty good indication of a strong competitive advantage.
That's a great tip. I'm adding that to my detective checklist.
Yeah.
What's the next financial clue we should be examining?
Well, let's talk about debt.
Okay.
While some debt can actually be healthy for a company, too much can be a major red flag. It's kind of like having a mortgage that's too big for your income. It can put a strain on your finances and make it really hard to handle any unexpected expenses.
So how do we know if a company has like a healthy amount of debt? Are there any specific ratios or metrics we can use to kind of assess this?
Yeah, a key metric here is called the debt to equity ratio, and this compares a company's total debt to its shareholder equity.
Okay.
So that's the value of the company belonging to its shareholders. And generally, you want to see a ratio that's below 1.
Okay.
Anything higher than that could mean they're relying too much on borrowed money.
Okay, so lower is generally better when it comes to the debt to equity ratio.
Exactly. It suggests a company is managing its debt responsibly. The book actually dives into this using McDonald's as an example. And while their ratio was slightly above 1, they highlight that, they could pay off their total debt in less than 4 years using their net income before taxes.
Hmm.
So that's considered a pretty healthy time frame.
Okay.
Yeah.
So it's not just about the ratio itself, but also about the company's ability to like manage and repay that debt.
Exactly. Looking at the bigger picture and assessing their overall financial stability.
Got it. This is fascinating stuff. Okay, what other financial clues are we on the hunt for?
Well, let's talk about return on equity, or ROE for short.
Okay.
This metric reveals how effectively a company is using shareholder investments to generate profits.
So it's like a measure of how much bang for the buck investors are getting.
Exactly. A higher ROE means the company is generating more profit for every dollar of shareholder equity. It's a sign of smart management and efficient capital allocation.
Okay, I see why ROE is so important then.
Yeah.
Higher is
Yeah.
generally better, right?
For the most part, yes, but it's also really crucial to compare a company's ROE to its industry peers. So a high ROE in a slow-growing industry might actually be a better investment than a lower ROE in a high-growth industry.
So context is key. It's about comparing apples to apples.
Exactly.
All right, so we've covered revenue net income, competitive advantage debt, and return on equity. What's next on our detective checklist?
Now let's dive into the world of dividends, specifically starting with something called the payout ratio.
Payout ratio. Tell me more about that one.
Sure. So the payout ratio tells us what percentage of a company's earnings are paid out as dividends.
Okay.
For example, if a company earns $1 per share and pays out $0.50 in dividends, their payout ratio would be 50%.
Okay, that makes sense. Is a higher payout ratio always a good thing?
Not necessarily. While it might seem really tempting to chase those high payouts, a very high payout ratio, so say above 80%, could actually be a warning sign.
Hmm.
It might mean that the company is struggling to reinvest in its business for future growth, or that its dividend isn't sustainable in the long run.
So it's like a company living paycheck to paycheck. They might be able to pay out a lot now, but it doesn't leave a lot of room for, savings or unexpected expenses.
Exactly. It's crucial to find that balance between rewarding shareholders with dividends and reinvesting in the company's future.
So what's a good rule of thumb when it comes to the payout ratio?
I typically look for companies with a payout ratio below 60%.
Okay.
This suggests that they're retaining a good chunk of their earnings to fuel future growth.
60%, got it. Are there any examples from the book that illustrate this concept?
Yeah, the book actually contrasts PepsiCo and McDonald's.
Oh, interesting.
So PepsiCo has consistently kept their payout ratio below 60%, even during the 2008 recession,
Hmm.
which suggests that their dividend is sustainable and they're really committed to balancing those payouts with long-term growth.
That's definitely reassuring to hear.
Yeah.
What about McDonald's? How do they compare?
So McDonald's payout ratio has been climbing steadily over the past decade, exceeding 70% in recent years. And this, coupled with, their kind of recent struggles to attract new customers, it does raise some questions about the long-term sustainability of their dividend.
That's definitely something to keep an eye on then.
Yeah.
So payout ratio check. Now let's talk about dividend yield, another term I often hear but don't fully understand. Can you break that down for me?
Sure. So dividend yield is simply the annual dividend payment per share divided by the current share price.
Okay.
It essentially tells you how much income you're getting for every dollar you invest.
Okay. So if a stock is priced at, let's say, $100 and it pays a $4 dividend, the dividend yield would be 4%.
You got it. And it's tempting to think higher is always better when it comes to dividend yield.
I could definitely see the appeal of chasing those bigger
I
yields.
know, right? But the catch is that a high dividend yield can sometimes actually be a red flag.
Really?
Yeah, it might mean that the company's share price has dropped significantly, perhaps due to poor performance or, concerns about their future.
So it's like a siren song that might lure investors into a potentially risky situation.
Exactly. A high dividend yield might look enticing on the surface, but it's really crucial to investigate why that yield is so high. It could be a hidden gem, but it also could be a trap.
Okay, I'll make sure to keep my detective hat firmly in place when I'm evaluating those yields.
Yeah.
Now, I know there's another important ratio that we need to discuss, and that is the PE ratio.
Yes.
Can you explain what that is and why it matters?
So the PE ratio, or price to earnings ratio, measures how much investors are willing to pay for each dollar of a company's earnings.
Okay.
And it's calculated by dividing the current share price by the company's earnings per share.
Okay, so if a company's stock is trading at, let's say, $50 and their earnings per share are $5, their PE ratio would be 10.
That's exactly right. And the PE ratio is often used to gauge whether a stock is overvalued or undervalued.
Got it.
A high PE suggests that investors are optimistic about future growth and willing to pay a premium. A low PE might indicate less confidence in the company or even a potential bargain.
So how do we know what's considered like high or low? Is there a magic number we should be looking for?
There's no one-size-fits-all answer because it depends on the company's industry and its growth rate and the overall market conditions. But as a general rule of thumb, a PE below 15 is often considered attractive,
Okay.
while a PE above 25 might signal that the stock is overvalued. And the book gives some good examples. They talk about Walmart and Chevron. Walmart had a PE of 12.68. So that means you're paying $12.68 for $1 of their profit. And then Chevron's was even lower at 9.6. So that suggests it might be a better deal.
So based on the PE ratio alone, Chevron seems like the more appealing option.
That's right. But the book also emphasizes that we shouldn't rely solely on the PE ratio. We need to consider other factors, their dividend history, their growth potential, and their overall financial health to get a complete picture.
It's like piecing together a puzzle using all these different metrics to determine if a company is a worthwhile investment.
Exactly. Each piece of information helps us paint a clearer picture.
This is all making so much sense now. So let's say we've thoroughly investigated a company. We're confident that it's a solid investment. How do we go about actually building a diversified portfolio of these dividend-paying stocks?
That's a fantastic question, and that's what we'll explore when we come back.
Okay, so we're back. And I am uh, ready to tackle the next stage of our dividend investing journey, actually building a portfolio. I'm eager to start, putting all this knowledge into action. But I'll admit, I'm also feeling a little overwhelmed.
I bet.
There are so many companies out there.
Yeah.
Where do we even begin?
Well, it's true. The sheer number of choices can feel really daunting. But remember that golden rule of investing diversification. We don't want to put all our eggs in one basket, right?
Right.
So instead, we need to spread our investments across, different companies and industries and even geographic regions.
So it's like creating a safety net for our portfolio.
Yeah,
If one company has a rough patch, the others can help cushion the blow a little bit.
that's a great way to think about it. Diversification is all about managing risk and increasing our chances of consistent long-term returns. And this book suggests kind of a really cool framework for this. It suggests building a portfolio based on the 10 U.S. stock market sectors.
Okay, 10 sectors. That sounds like a good framework. But I'll be honest, I'm not super familiar with all of them. Can you give me a quick rundown?
Yeah, absolutely. So let's start with consumer staples. This sector includes companies that produce those essential goods people use every single day, regardless of, the economic climate. Think food, beverages, household products, personal care items.
So even if the economy takes a hit, people still need to buy their toothpaste and toilet paper. Makes sense. Are there any particular companies that stand out in this sector?
Yeah, some big players in this sector are companies like Procter& Gamble, Kimberly-Clark, Coca-Cola, PepsiCo. These companies, they tend to be really stable and reliable dividend payers because, again, people need their products even during, economic downturns.
That makes a lot of sense.
Okay.
What's the next sector we should be thinking about?
Well, next up is consumer discretionary. So this sector includes companies that sell goods and services that are considered non-essential. So think cars, clothing restaurants, travel entertainment.
So things people might cut back on if times get a little tough.
Exactly. While this sector, it can be affected by economic swings,
Right.
many companies here, they have strong brand recognition. They have loyal customer bases, which provides some resilience. So companies like McDonald's and Walmart and Disney and Nike are all part of this sector.
Okay, so we're looking for companies that offer something special, even in a sector that might be more sensitive to economic ups and downs.
Got it.
What about the energy sector? I imagine that could be, pretty volatile at times.
You are right. The energy sector, which includes companies involved in, the exploration, production, and distribution of energy resources, can be quite volatile
Right.
due to, fluctuating commodity prices. We're talking oil and gas companies, renewable energy companies, pipeline operators.
So this is a sector where, we might need a slightly higher risk tolerance.
That's a good point. Energy can be a bit of a roller coaster, but it also plays a crucial role in the global economy and can offer attractive dividend opportunities.
Okay, duly noted. Now, what about healthcare? It seems like that would be a pretty stable area to invest in given the aging population and the growing demand for healthcare services.
You're spot on. The healthcare sector is generally considered defensive, meaning it tends to perform well regardless of the economic cycle. So this sector includes companies involved in pharmaceuticals, biotechnology, medical devices, healthcare providers, health insurance. And as the global population ages and the demand for healthcare services increases, this sector is poised for continued growth.
That's definitely encouraging to hear.
Yeah.
Okay, we've covered consumer staples, consumer discretionary energy, and healthcare.
Yeah.
What about financials? I always think of banks when I hear that term,
Sure.
but I know it's a much broader sector than just that.
Yeah, you're right. Financials encompass a wide range of companies, including banks, insurance companies, investment firms, and real estate investment trusts, or REITs.
So it's a sector that's deeply intertwined with the overall health of the economy then.
It is. Financials can be sensitive to interest rate changes and, overall economic conditions.
Right.
But they also play a really vital role in facilitating economic growth.
All right, financials check.
Yeah.
We've covered 5 sectors so far. What are the remaining 5?
So we have industrials, which include companies involved in manufacturing, construction, aerospace. We've got information technology, that's everything from software and hardware to semiconductors, internet services. We have materials, so companies that produce and process raw materials like chemicals, metals, lumber. Then there's telecommunication services, which includes companies providing communication services like telephone, internet, and cable TV. And finally, we have utilities. So these are companies that provide those really essential services like electricity, gas, and water.
Wow, that's a lot to take in.
Yeah.
So to create a well-diversified portfolio, we should aim to invest in companies across all 10 of these sectors.
Exactly. By spreading your investments across these various sectors, we're not overly exposed to the risks of any single industry.
Now, I know the book actually suggests specific portfolio weightings for each sector, right?
It does.
Can you walk us through those recommendations?
Yeah, absolutely. So the book recommends allocating 20% to consumer staples, 18% to consumer discretionary, 17% to financials, 14% to healthcare, 10% to industrials, 6% to information technology, 5% to materials, 5% to utilities, 3% to telecommunications services, and 2% to energy.
Okay, those percentages give us a great starting point for building a balanced and diversified dividend portfolio.
Right.
But even with careful diversification, we can't completely eliminate risk, can we?
That's true. The stock market will always have its ups and downs.
Right.
It's part of the nature of investing. But the key is to focus on the long term to ride out those inevitable market fluctuations and not panic when things get bumpy.
So it's less about trying to time the market perfectly and more about just having a solid plan, staying the course, and weathering those storms.
You got it. And that's where, having a strong investment mindset comes in.
Fair.
It's about discipline, patience, and the ability to overcome fear and stay focused on those long-term goals.
Speaking of fear, let's address the elephant in the room here. The stock market can feel pretty intimidating, right?
It can.
All those crashes and fluctuations can make even the most experienced investors nervous.
Yeah.
What are some of the, common fears that people have when it comes to investing?
Where I think two major fears often hold people back. The first is the fear of companies going bankrupt and leading to a complete loss of their investment. And the second is the fear of a market crash wiping out, a big chunk of their savings.
Those are certainly understandable fears.
Yeah.
How does the dividend investing strategy outlined in this book, help address those concerns?
So by focusing on, high quality blue chip companies with a proven track record of dividend payments, you're essentially investing in businesses that have weathered those economic storms and come out stronger. And remember, diversification is key. By spreading your investments across multiple companies and sectors, you're reducing the impact of any single company's misfortune.
So it's about building a resilient portfolio that can
Right.
withstand those inevitable market fluctuations.
Exactly. And it's about shifting your perspective a little bit. Instead of viewing the stock market as a source of, fear and anxiety, see it as a vehicle for building wealth and achieving your financial goals. Embrace the long game, knowing that the market, will inevitably fluctuate. But over time, high quality companies tend to grow and reward their investors.
This has been an incredible deep dive into the world of dividend investing. We've gone from understanding, the very basics of stocks and dividends to analyzing companies and building a diversified portfolio. It's been an amazing journey.
And the best part is it's a journey that anyone can embark on regardless of their financial background or their investment experience.
I love that.
It's about taking control of your financial future and building a legacy of wealth that can last for generations.
Absolutely. If you've ever dreamed of having your money work for you, generating income, even while you sleep, dividend investing might just be the path for you. And this deep dive has given you the tools and knowledge to get started. So what are you waiting for?
Take that first step. Open that brokerage account. Start exploring this exciting world of dividend investing. You might be surprised at the possibilities that await.
Couldn't have said it better myself.
Yeah.
Thank you so much for joining us on this deep dive into dividend investing. We hope you've gained some valuable insights and feel empowered to take control of your financial future. Until next time, keep learning, keep growing, and keep diving deeper.